Hello, everyone. Today is September 3rd. This is the Northbound Wealth Podcast. Thanks for tuning in and listening. Let's dive in. Stocks react to key data and earnings. There were mixed results for stocks last week as upbeat economic data and a critical second quarter corporate report shaped the week. The Dow Jones Industrial Average rose 0.94%, while the S&P 500 increased 0.24%. The Nasdaq Composite lagged, falling 0.92%. The MSCI EAFE Index, which tracks developed overseas stock markets, gained 0.35%. So what's going on? What's the deal? Markets began the week as investors awaited the second quarter earnings from NVIDIA, the world's most influential name in artificial intelligence. The chip maker, the second largest stock in the S&P 500 by market cap, dipped on the news, putting pressure on the Nasdaq and S&P. The Nasdaq and the S&P are market weighted averages, so larger companies have an outsized impact. NVIDIA is mentioned to show its influence on the overall stock market. It should not be considered a solicitation for the purchase or sale of the company. On Thursday, an upward revision in GDP, or gross domestic product data, boosted markets. Although stocks fell later in the day, Friday's personal consumption expenditures, or PCE, data seemed to confirm that inflation remained tame. Welcome news for investors who are anticipating the Fed may adjust rates in September. So, Y charts. We got the major market index return summary. Dow Jones Industrial Average year to date's up 11.07%. MSCI EAFE Index, which is the overseas, is up 12.16% year to date. Nasdaq Composite's up 17.24%. S&P 500's up 18.32%. And the 10-year Treasury note is trading at around 3.91% and still hanging in there on the downside. And that when there's a backup in yields, that's what happens. We were at 4.55 about 3 months ago, and now we're at 3.91. Softer landings in focus. So several pieces of data helped build a narrative that the economy may be coming in for a soft landing. Second quarter GDP growth was revised upward from 2.8% to 3%. That's an improvement from Q1 GDP, which rose 1.4%. Some market watchers were concerned about the second quarter revision after pending home sales in July hit its lowest monthly levels in 23 years. Meanwhile, the Federal Reserve's preferred measure of inflation, the PCE index, came in at 0.2% higher in July, in line with expectations. Core PCE inflation, which the Fed tracks closely, edged up 0.2%, also in line with forecasts. So what do we got going with economic data this week? Tuesday, ISM manufacturing. We've got construction Wednesday, international trades and goods and services, motor vehicle sales, factory orders Thursday, jobless claims in the ADP report Friday, employment situation, and Fed official John Williams speaks. So pretty busy week on the economic data front, but light on the companies reporting earnings. We got Wednesday, Hewlett-Packard, then we got Dollar Tree, and then on Thursday, we got Broadcom. And so I'll be tracking those. What's interesting is Dollar General reported last week, and they really indicated a slowdown in their customer base, which is lowering consumer. So I think that helps support maybe the Fed's going to be lowering rates this month at some point. I would hope maybe 25 basis points at least to get the ball started and showing the markets that they're actually paying attention to data that they're behind on a bit at this point. All right, so tax tip of the week, reporting cash payments. So individuals, companies, corporations, partnerships, associations, trusts, and estates must report cash transactions of more than $10,000. These cash payments can include jewelry sales, a gift from a family member, an overseas purchase, or any other cash transaction. You also need to report cash payments received in one lump sum, in two or more related payments within 24 hours, or as part of a single transaction or two or more transactions in the previous year. All you need to do is file a Form 8300, which is called the Report of Cash Payments Over $10,000 Received in a Trade or Business. Let the IRS handle like a title of a form. Jeez, oh Pete. The form requires information about the giver and receiver of the cash, a description of the transaction, and information about any other parties involved. And again, this information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax professional, and this tip was adapted from irs.gov. Stay tuned for the next segment. So new data from the Bureau of Labor Statistics reveals a significant adjustment to our understanding of the job market. Here are the key points. 818,000 fewer jobs existed in March 2024 than initially reported. This marks the largest downward revision since 2009. The average monthly job gains from April 2023 to March 2024 were 173,500 versus the previously reported 242,000. While this revision is substantial, it's important to remember that job growth was still historically strong. This data gives us a more accurate picture of the labor market's health and could influence the Fed's decision on interest rates. Do not hesitate to reach out if you have questions about how this might affect your financial goals. I think this data and this adjustment points to the Fed lowering rates, frankly. The latest Fed minutes suggest we might see that interest rate cut as soon as September. That's this month. Here's what you need to know. Most Fed officials believe easing policy could be appropriate if data continues as expected. So we are going to get more data this week that should be crucial to their decision-making on whether there's a rate cut this month. Markets are fully pricing in a September cut. Inflation is moving towards the 2% target, but labor market risks have increased. What does this mean for your portfolio? It's a great time to review your investment strategy and consider how potential rate changes might impact your financial goals. Stay tuned for more updates, and don't hesitate to reach out if you have any questions about positioning your finances in the changing economic landscape. You can reach us at 317-399-1107, 317-399-1107. Stay tuned for the next segment. As we approach the 2024 presidential election, some may wonder about its potential impact on their finances. While elections are undoubtedly important, we've done some homework and come to the following conclusion. You may care passionately about who wins, but your investment portfolio probably doesn't. Here's some key insights. Markets over the long term. As the accompanying chart shows, which is in this email and then blog that I'm going to be posting here soon, the stock market has fluctuated under the leadership of both parties. However, the long-term trend suggests that the stock market's performance may have more to do with the overall strength and resiliency of the U.S. economy than the person who sits in the Oval Office. Economic factors. Data suggests economic trends tend to have a more consistent relationship with market performance than who wins in November. Improving economic conditions, which can include falling inflation, for example, or lowering of interest rates, for example, or great earnings reports from companies, tends to create a more favorable business environment. Prepare for short-term volatility. This definitely happens around election cycles. While elections can trigger some market volatility, it's critical to keep short-term events in perspective and not allow them to distract you from long-term financial strategy. Often, the best approach is to create a portfolio that reflects your goals, time horizon, and risk tolerance. Tax policy differences. Keep in mind that what can have more of an impact on your finances than taxes, right? Tax policy. But remember, the president can lay out a tax policy, but it is up to Congress to pass any tax legislation into law. Tax changes take time. The tax policies outlined by Republicans and Democrats are based on assumptions and will be subject to revisions during the legislative process. We encourage you to consult your tax, legal, and accounting professionals before modifying your tax strategy. We always welcome collaborating with your tax professional to help you align with your financial and tax strategies. And the market's trend is apolitical. You're basically if you just stay invested through the volatility and over long periods of time, despite the different Democrat or Republican who's in office, the economy is stronger than both. And you also have the checks and balances of Congress a lot of the times. So the market's trend is apolitical. I'm going to have this chart posted for those of you who are interested. Growth of $100 in the S&P 500 since December of 1943 under Democratic presidents and under Republican presidents. And if you take a look at that chart when I post it, you'll see that the performance and the returns are about the same. So if you have any questions about your financial strategy in light of the upcoming election, please don't hesitate to reach out to Northbound Wealth Management at 317-399-1107. And this information was derived from Baird.com, March 2014, a U.S. Bank, Tax Foundation, and CNBC. So thank you for that resource. Stay tuned for the next segment. Have you ever wondered why a donkey and an elephant became the symbols of our two major political parties? Political cartoonist Thomas Nast made these symbols popular in the 1800s. In 1870, Nast satirized the Democratic Party as a donkey, mocking their stubbornness in the face of progress during the Civil War era. The symbol resonated with the public and it stuck. Over time, Democrats reclaimed the donkey, transforming it into a symbol of their determination, resilience, and tireless work ethic. In 1874, Nast struck again, this time depicting the Republican Party as an elephant. Nast chose the elephant to represent the party's strength, intelligence, and dignified nature, traits the GOP sought to embody. Today, these mascots continue to embody the spirit of their respective parties as we head into another election season. So there's some fun information for you to take with you as you go to the voting booths here in a couple of months. Emotions play a significant role in our relationship with money and financial decisions. For some people, deep-rooted emotional obstacles tied to money can make certain aspects of personal finance more difficult and stressful. Financial trauma is a real and impactful consequence of experiences like childhood poverty, economic downturns, fraud, and more, and can manifest itself during the personal financial process. Some examples are financial inaction, feeling overwhelmed and unable to take control, decision paralysis, difficulty making financial choices due to anxiety, then scarcity mindset, a pervasive fear of running out of resources. Recognizing these and other potential roadblocks is crucial for pursuing financial well-being. Financial professionals can offer a supportive environment to help address some of these challenges. They're way more common than you might think. So, it doesn't matter if you have low stress or high stress or somewhere in between. It's always good to maybe talk to a financial advisor, financial counselor, someone to guide you in the right direction. Here at Northbound Wealth Management, we'd be happy to have that conversation with you. You may reach out to us at 317-399-1107. We'll talk to you soon. Have a great weekends. We'll talk to you next time. Thanks for listening. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast.